Hey folks, and welcome to the Pipnotic Symposium for the 25th of October 2019. Okay, today we are going to analyze one instrument. It doesn't really matter what it is because the analysis will be the same for whatever asset we decide to trade. Okay, so we're just going to grab this random pair. This is the Swiss franc Japanese yen. Okay, so you have this chart, you're looking at it and you're wondering, what do I need to do? What you need to do before you do anything else is you need to identify what the major flows are doing. And so this is answering the question, what is currently driving price? And we're on the hourly chart, and do you think the major flows are visible on the hourly chart? Well, the answer is yes and no. Maybe they are, maybe they're not. But on this time frame, we can see that there's not a lot of clarity. We can see that price came down from here and then it went up and then it went down. We can't really see if price is higher back here or if price is lower back here. And so for this we need to go to the bigger time frames. Okay, so we click onto the daily chart. You can see very clearly here that we have price that was wriggling lower. It wriggled down into this daily demand which was tested, and now we're slowly advertising cheaper prices for this asset in an attempt to attract buyers. Okay, and we got that very clearly, and you can see that we got that because we zoom in just a little bit. We had these the bodies of the candles. They were trading low. We had like the bodies of the candles moving lower here, and now we have the bodies of the candles trading above the highs of previous significant swing points. Okay, and so we have market structure that is being violated. When I say violated, I mean that we have historically respected areas that are being moved through. Okay, and so we had a high here, we had a high here, a low, and a low. So this is an important level, and this level has been moved through by bleeding edge price. Just here you can see the price managed to trade above that area. So what does that tell us? Well, that tells us that this advertising of discount prices for this asset, it actually paid off because we were driving price down. We're advertising these really attractive prices for this asset, and we saw some interest which pushed price higher above these highs. Okay, so the highs and the lows we'll refer to as market structure. So we have market structure that looks like that, and you can see that market structure has failed in that price failed to respect the historically established structure of the market. And this you can see by price trading above here. Okay, a lot of people refer to this as a breakout. And I think breakouts are potentially dangerous because you also have price that needs to break out of respected levels in order to attract either sellers if you're moving through supply or buyers if you're moving through demand. So this could just be an attempt to attract sellers so that we can move lower. But notice that there isn't any supply up here. There's no supply here. So this is just price moving through these historically respected levels. Okay, so if you look at this, maybe this time frame doesn't give you enough clarity, so maybe we'll have to go to a bigger time frame to see. And if you look at this time frame here, oops, wrong zoom. Look at the most recent weeks of trading. We have a very strong push higher. We have another very strong push higher. What does that tell you about the order flows for this particular asset? Well, we can see that things are pretty bullish. We had a week of buying and another week of buying, and now we're having a bit of a rest this week. Today being Friday, so price is kind of having a dip lower. What are we doing? We're advertising cheap prices in attempts to reestablish this upward trend that we're seeing here if we focus on the past 3 weeks of trading. Okay, and so with this information, we have a directional bias for the time being, and this is a short-term time being, which is moving higher, so higher prices. Okay, but notice also in this time frame, we have other things that we need to be aware of. We have this high here, so price reacted at something in here. We can't see what. Okay, and we have this area here of supply, and this is an area of supply because when price left this area just here, it moved through this area of demand. So I can't draw like that here. It moved through this area of demand. So you ask yourself the question, what area of supply is responsible for consuming this demand, and it's this one here. Okay, so this is where we expect price to react most aggressively once price returns to it. And this is important to us to know because in forex in general, it's a distributed market, and so we cannot get accurate volume information. I can't see if I'm looking at the order books, I can't see how much of this asset is being sold here. I can't see the pending orders in here. I can't see what was in here. I can't see what's down here, and I certainly can't see what's up here because my broker has limited access to this information. They can, of course, show me information that is applicable and relevant for the clients that are trading through them, but they can't. This is a fraction of what is actually going on in the market. So if my broker typically has traders who lose money, well, the order flow information that they can provide to me is going to probably get me into a bit of trouble. And this is typically the case because most retail traders fail to trade profitably. And so the only thing that we can use to gauge the strength of an area is to see what it was historically able to do. Okay, so we had this area of demand here. I'm going to use my rectangle drawing tool here. It's better. So we had this area here. Okay, and this area has been violated, it's been consumed. And so you ask yourself what area of supply managed to move through that? What's the origin of the move that moved through this demand? The origin of the move is here. Okay, so you have to focus on the origin of the move. When I say the origin of the move, you have the move that went through, then you have to backtrack. Where did that move start from? And the move started from here. And notice we have a purple dotted line here. This is telling us that we have monthly supply above. So this was what drove price to move lower through this weekly demand. Okay, and the reason we need to know what the origin of the move is because this is where price will typically return to in an attempt to advertise the same kind of selling pressure we experienced or we saw when price was there historically. Okay, so roughly towards these highs. Okay, price came down, we moved through it, and now we have to find the area of supply that was responsible for removing this, and that we saw once price returned to where? To the origin of the move that took out this supply that now no longer exists. So this is where we have to look to trade. We focus on the origin of the move, and this is where we position ourselves to sell in anticipation that the next time price comes back to this area, it'll move through. And notice here that price had a bounce. And why did it have a bounce? Well, it had a bounce because we had micro supply and demand, micro areas of supply and demand on the chart that also include pools of liquidity for traders that are looking to settle perhaps intraday or shorter term. Okay, and so they have they're not looking at the weekly chart, they're looking at maybe the daily chart or the 4 hour, the 1 hour, and they're not interested in these longer term macro views. They're looking to find the best price today or the best price this week. Okay, and so these are also contenders. Okay, and so this is really important to us. So price went down, but notice here that we came down into here, we bounced up, you can see the wick here, we bounced up again, we slowly ate through it, and then we managed to wriggle lower, and then we had this extended period of accumulation where price is accumulating orders to drive price higher back to the origin of the move that took this out. And on the way, we had some struggles. Okay, notice we have this here, just here. Here we have an accumulation distribution candle, and this candle is interesting to us because this is the origin. This is kind of the move that went through it is this one. The origin of the move is here, but this is a continuation pattern. So this is like the building up of orders on the way down to this area. So there's a likelihood that price will bounce here once it comes here, and there is a higher likelihood that price will bounce once it comes back to the origin. So we had this one here. This one is no longer gone. What area consumed it? It's this one here. Notice that this one is gone. Okay, this is not the origin of the move that removed this one. This is the origin down here. Okay, so price went up, now it came down, and the origin of the area that removed this weekly demand is up here. Okay, notice also we have a continuation pattern here and here. What does that mean? We have micro supply here and we have micro supply here, and this one is the one that's responsible for removing that. This is not weekly supply, this is probably daily or 4-hour supply, but it was significant enough that it was able to consume this area of weekly demand. So what you do here is you take your rectangle tool and you mark it off like that, and you go down to the smaller time frames to have a look at what's going on inside here. If we do that, okay, you can see a lot more clarity on these smaller time frames. So initially we had this area here, price left, we came down, and this area, this little price structure here, this accumulation candle, is the one that was responsible for removing this, because this is where we had a little pause. And this is a little bit misleading because we have the anatomy of these candles here. I mean, they all resemble distribution candles, but they're not formed equally. These ones up here with the smaller bodies are better, and ideally what we like to see is we like to see the bodies of these white candles, these are accumulation distribution candles, to be within the range of the previous. And notice that the body of this candle is not within the range of the previous candle. So that tells us that here, that this is a continuation pattern. We can't see it on this time frame, but on a smaller time frame, we can get clarity and we can find out exactly where we can expect price to react. So it requires we go down to a smaller time frame in order to find the clarity. And here we can see it. So you can see it right here. Here we have a parent-child relationship where we have the parent, which is the top level, and the child, which is this level. And this simply means that the parent is established independent of any other area of supply or demand, and the child is established as a result of the existence of another area. Okay, the other area being the parent, hence the expression parent-child supply and demand. And so what we do in a situation like that is we would typically take the parent, but due to the fact that they're so close together, we would just box off the whole area like that. And so this is the area that we can expect price to bounce in the future. And this is interesting because, I mean, price came down, we moved sideways. What does that mean? That means that people are pleased paying this price for this asset. That means that we have perceived value for the Swiss franc, Japanese yen at this price level. And then all of a sudden price leaves. What does that mean? Well, that means that people are willing to pay lower prices. Okay, so people who did not manage to get in trades at this area here, once price leaves, they'll be thinking, oh, that was a shame. I didn't manage to sell at this price level, but price has established a new area of value, and so, hey, maybe I'll get in at that level. And so once price starts to do this, then the perceived area of value moves lower. Okay, and what does that mean? Well, that just means that here we have a really nice area of value, and the reason we know it's a nice area is because the departure from this area was very forceful. This is telling us that there was a lot of transacting going on here. Okay, many transactions were made here. There was a lot of selling here. There was a lot of distribution of liquidity, so moving from the buyers to the sellers. Okay, and this created an imbalance in price, causing the price of this asset to move away from this perceived area of value. So price cut away, and we can see that here. Do we see the same behavior in this area here? No. And how can you tell the difference? Well, you can tell the difference by looking at, asking yourself the question, has price been back to this area since it was established? And notice here, has price been back to this area since it was established? It was established by this candle. This candle told us that this is an attractive area. And notice that there's black space from where the candle is all the way into the future to where price currently is. Okay, so price has not been back to that area. Has price been back to this area? It has. Where? It's been back here, and it's been back here. What does that tell us about this area of value? It means that it's an okay level of value, but it's not as good as this area of value. So I will be waiting patiently. I'll sit on my hands and I'll wait for price to return to this area of value, this area of supply, and I'll pass on this one because this is a better price to sell at. Okay, and you'll hear me refer to the beginning of buy and sell zones. And when you have an area that's established like this with such a nice departure, and this isn't even that good of a departure, it's just a decent departure. There are other departures that are much nicer. We'll see some examples in future videos. But we can see price left, and then you want to mark off the highest high since the departure, which is the highest high of a candle that attempts to move back up into this area of value, this area of supply. And you see that just here. So this is probably where we're going to see price react again at a later date. So remove this one because we're not interested in this one anymore. And if we scroll forward, you can see we managed to find the beginning of the sell zone, and price will typically move deeper into the sell zone, because what I like to do is I like to view areas of supply and demand as pancakes, plates of pancakes. So we have a plate that looks like this. Okay, then we put pancakes in them, like so. So we have these plates of pancakes like so. Okay, now assume that, let's say this is demand. Okay, so this is below price. Let's assume now that somebody wants to come and take a pancake. What do they have to do? Well, they take their fork and they move their fork into the plate. Which pancake is their fork going to touch first? Is it this one? No, it's not. It's this one. It's the top pancake. Okay, so after this pancake is removed, that one's gone, the next fork is going to have to move lower to get this one. Okay, and once that pancake has been taken, then the fork's going to have to move lower once again. Once that one's gone, it's going to have to move lower until finally there are no pancakes. And what happens when there are no pancakes? If you're eating pancakes around the table and there's the plate of pancakes and the pancakes are gone, what do? Well, you start looking for another plate of pancakes. Okay, so this pancake plate is gone. So then you look for another plate on the table, and this one has not been eaten yet. So this one is going to be filled with pancakes. And so you don't look at this one anymore, you look at this one. So your fork goes here. And when that one's gone, this one's gone, then you move to this one, and so on and so forth until there are no pancakes. Okay? And so what I'm trying to say here is that pancakes are a metaphor for supply and demand. Okay, this is where the first pancake is. But in this situation, because it's supply, we have the plate upside down. We define gravity. The pancakes aren't falling out of the plate, so we have them here. And so this line here corresponds to the first pancake. Once price comes up to this level over here, then this one is gone. What will price slash a fork have to do in order to find the next pancake? It's going to have to go deeper. It's going to have to move to this one. When that one's gone, it's going to have to move to this one. And the same applies with supply and demand. Okay, price moves deeper and deeper and deeper until it finds the bottom of the plate. And for supply and demand, the bottom of the plate is the top of the edge of supply or demand, which would be the bottom. Okay, but for this one here, I mean, when everything's gone, then you touch the bottom of the plate, then what do? You start looking for a new plate. And on this chart, just eyeballing, where's the next plate? We have this one here. This is like the next plate. Why? Because price left and it has not been back to that plate of pancakes, that pool of liquidity, since it was established. Okay? And maybe chew on the metaphor of pancakes. I use it a lot because I think it's just a really nice way to visually represent what supply and demand is. And so you see this, you expect price to do this. Okay? So the first fork comes back, it comes up into here. So the next pancake is going to be at the highs of the next pancake. If you look here, price came to it precisely, it moved away. So we maybe nibbled, we took maybe half a pancake, then it went through it. What does that mean? That means the next one is higher and higher and higher and higher and higher. And finally it goes up there. And this was enough. Then the sellers, where are we? Then the sellers are actually done trying to sell, and so the people sitting around the table, they're done eating pancakes, so they're all full, they've had their share of pancakes, and now they're done. And when in a market, the price will just move away. Price will leave. Okay, all the forks will be put down on the table and then price will leave. And we're seeing that here. So what does that mean? What does that mean? Well, that means that next time price comes back to this area, unless price has gone all the way through this area of supply, so there are no more pancakes on the plate, we can continue to nest our orders to sell at the deepest level of the test of this area of supply. Okay, and so I mean this is fine. If we look at this, I don't know if price has been back there since. No, this is still very far above price. What does that mean? Well, that means that the market has established other plates of pancakes have been put on the table. You can see we have some here. We had like a nice departure, black space, nice departure, but price came back up to this one, so this is uninteresting. But the one that we have that was interesting since then is this one here. Okay, black space, price poked up to the area, to the plate, took the first pancake, and that was a very filling pancake, and that satisfied the sellers, the people who are eating. Hope this doesn't confuse you too much. Okay, and then price retreats. Okay, what does it do next time? Well, it has to go deeper. But notice that we've actually formed, the pancakes are so good that the new plates have been put on the table. Okay, we have one here. Okay, the beginning of sell zone was here, because this is where the highest test was. Tested it and it kept going deeper and deeper and deeper. Can you see that we have a high, another high, a deeper high, and deeper high? Okay, and so you look at a price chart and you think, wow, this is really random. And the answer is, it is not random at all. It's a storybook, and it's telling you a story of how hungry buyers and sellers are. Okay, and this is it's doing exactly what it has to do. This is doing exactly what the market was designed to do. Okay, and so you can just see this very clearly, that prices were increasing until they couldn't increase anymore, and until they stopped attracting people who were keen on engaging in the market, then price left. Okay, but it left this area of, and this is micro value here, it left so quickly that people were like, oh, I didn't get into that, I didn't sell at that really attractive price. Okay, I'll wait for price to come up. So price comes up, it gets close, then they engage in the market here, because this is newly established area of value. Price leaves, and the same thing happens over and over again. Higher, 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 higher. This is consuming liquidity at this major pool of liquidity here. Okay, and then you have these micro areas of liquidity that are established below. Okay, and the story goes on and on and on. And you see, if you look over here, we have that nice departure. We have a nice area just here. We have a nice one here. We have a nice one here. We have this one, but price went down, it came up. So this is the beginning of the sell zone there, maybe. This is not so interesting because there's a lot of trading in here, and so that means people like eating pancakes. When price hangs around in an area like that, these are like maybe people nibbling on pancakes. Okay, and so when you see price moving around in an area like this for an extended period of time, that means that so many people are taking bites out of the pancake that's on the plate that eventually that pancake's going to disappear. And this is the equivalent of price kind of moving higher and removing like entire pools of liquidity. Okay, so this is like small bites of liquidity, and this is just a pattern that is telling you that liquidity at this area is being diminished, and this you can see by price sitting in an area for an extended period of time. Okay, so price moves away. Here we had a really nice cutaway. Price had not been back. We tested it. It left. And price is forever creating these lower prices like so, because this is what is required to encourage people to start to buy. We're advertising these low prices. Prices shot up a little, as attractive, but not that much. A little bit cheaper, okay, not so much. A little bit cheaper, a little bit, not that much. A little, and then we went all the way down here, and this is a really good area. How do you know? Because price left. Okay, so this is an attractive price for this asset, meaning that when price comes back to that area, we can expect it to bounce. And if we have a look, you can see we had this area of supply that was established, where since the area that was established here, I mean, where is the wick? Where's the deepest pullback? You can see that we had a pullback here, because this candle here. But notice the body of this candle is not within the range of the previous candle. What does that mean? Well, that means that this candle and this candle are not related. This candle, and this candle, they're related. But this candle here and this candle here are not related. So the three candles, let me zoom in. The three candles in the middle, these three, they are related. And this one is not, and this one is not. This area here is coming from a previous area of value, and this, a previously perceived area of value, and this candle here is departing from this area of value. What does that mean? That means you have to find the low of this candle here, and this is where you buy. You don't buy here, you buy here, because this is a candle. I refer to this as a slingshot, where the slingshot is pulled back and then it leaves. Okay, so this is where people got full. This is where the buyers were content. Okay, so they came back down here and they said, good, they're full, they got all their orders filled, price leaves. So this is where we can expect price to bounce in the future. Price comes down, we have a really deep push, and we have massive rejection. Okay, and then price wriggles higher from there. Okay, so the same thing goes on all day long, on all time frames, on every asset in the world that is bought and sold in a marketplace, like currencies and commodities and bonds and futures and cryptocurrencies and all those things. Okay, yeah. I hope my metaphor doesn't confuse you. I like to create visual pictures in my head so that I can understand things, and the pancake metaphor is just something that resonated with me. Okay, and so that's what you're seeing here. So if we look at where price is now, let me delete everything. If we look at where price is now, where do we have these attractive areas, these attractive prices? Okay, well, first of all, we have to find an area that was consumed, like an area of supply or demand and consumed. And this you do by focusing on, as I mentioned earlier, historically respected areas that are no longer respected. And if you look here, you can see that we had this, price came up here, we tested, we tried to kind of move up into this area, and price left. That means that there was selling going on at this area here, at roughly this price window here. Just mark that off, we'll put it like this. This is maybe the average of the lows, sorry, the average of the highs for these candles here. It went through, and then price left. Okay, so we left, we sat on this area here, we had support here, historically respected area. We take an average of these lows, it's kind of around here-ish, like so. Okay, now this is gone, this one's gone. What does that mean? Then you have to identify the origin of the move that moved through this area of demand. The origin of this move is where, this moved through it, but the origin of the move is the top. So this is the area that we can expect price to bounce at in the future. Okay, this one was tested once, and now it's gone. What area removed it? It's this one here. So we move this like this. The software's found it. You go like that. And you ask yourself your question, well, where is price going to bounce? Okay, so this is where we do our little analysis. You say, okay, where do we have departure? We have departure on this candle right here. This candle right there. Okay? The body of this candle is in the range of the previous. The body of this candle is not in the range of the previous. And then these three here are linked together. Okay, so this is the beginning of it. And we have 1, 2, 3 candles that are related. And we have these 2 candles that are related. And so we have micro kind of continuation patterns. We have one group of these blue candles and one group of these red candles here. Okay, but the shift in value occurred with this candle. This is the previously accepted area of value. And we have this one, which is leaving. Notice the price has not been back to this area since it was established. What does that mean? Well, that means that we have to now find the low of that candle and that would be an area that we might consider to trade. And if you look at this candle, the lower this candle is right there. The lower the area is here. Okay, so we mark that area off. That is at the 108.98. Okay, so this is where this candle, the slingshot, was pulled back to before price left. This is really important. Okay, we look at this one here, we have accumulation 1, 2, and this one, the body of this candle is not within the range of the previous. What does that mean? Well, that means you mark off the low here with the low of the entire area, and this is where the trade is. Price poked into it and it left. Notice that these pancakes are gone. Where's the next pancake? Plate of pancakes? It's down here, and it begins at the 108.98. So when the hungry forks are looking for pancakes, they're going to be forced to go down to this one here. Okay, so that's how, at least how I like to analyze the charts. And it might be overwhelming. There are a lot of details, and there's a lot of terminology, parents and children and pancakes and all sorts of stuff, and forks and stuff, and it sounds complicated, but it's not. Anyone who tells you that supply and demand is complicated is trying to pull one over on you, because it is not complicated. All supply and demand is, there's something for sale in a marketplace and people can buy it or people can sell it. That's all that's going on. And essentially, as a buyer, you want to buy at cheap prices, and if you're selling, you want to sell at as high a price as possible. And this little analysis here is showing us where we have historically respected areas. So these are areas of value that people are keen on paying for an asset. We have that here. Okay, and when price leaves, this was the lowest price people were willing to buy, that is denoted by the pullback of the candle that leaves. This is the last price that people bought at before price left. Okay, so that's all it is. It's not rocket science. It's just a study of how price moves on a price chart. Because if you think about it, I mean, what is a price chart showing us? Is it showing you what has happened or what is going to happen? Well, it shows you what has already happened. So a candlestick chart or a bar chart is actually a lagging indicator, because it's showing you what already has happened. And so what you almost need to do is you almost need to create a negative of a chart like this one. You almost have to superimpose the black space on the chart and kind of remove the candles, because this is going to show you where price will likely move. And if you have a look, you can see, I mean, price went down here. This is a micro area in here. But on this time from the 4-hour chart, I mean, this move higher left from here. 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 This isn't a pretty one because price had to have 2 goes at it. This move higher left from here, and this one left from here. Okay, so this is the edge of the buy and the sell zone. This is the edge of the buy zone for this area. Okay, this is the edge of the buy zone for this area, and so on and so forth all the way up. We have this one here, and we have this one here, and we have this one here, which is kind of a thick one. Okay, and so this is price kind of poking into that area, filling orders, poking, and then leaving, and it leaves marks in the sand that look like this. So you almost have to see like the negative of price chart. Okay, I know this is a lot of information. You can watch this a few times. If you have any questions about the material here, please comment the YouTube video or send me an email, and I'll be glad to get back to you and cover your question. Also, we're going to be going over the same material over and over and over and over again. As a matter of fact, I have hundreds and hundreds of hours of recordings of this material like this, and what I normally like to do is every week or month or 6 months, I like to change how I present the information, just to try and present it or pitch it from a different angle, because some people get the pancakes metaphors, others don't. And so I don't want to always use the pancake metaphor because it's going to confuse some people, and so I like to present it in a different way. Okay, so this is one way of doing it, and next time, in the next video, I'll present it in another way so I can try and get a few more people to understand what it is that I'm talking about. But remember, this is not rocket science, okay? It's just a simple study of how the price of an asset moves in a marketplace like foreign exchange, okay? Okay, well, I'll leave it at that. I hope you enjoyed the video. If you do and you want something similar to this, or if you have input for future videos, let me know and I'll be pleased to incorporate your comments into coming webinars. Well, thanks for watching and I'll see you in the next video.